Why might chattering fail to work? It is easier for me to present the logical arguments against the chattering. First, it should be noted that the catalyst buys in many after price trends have been established and sells only after they have been broken, because sharp reversals in the market may occur quite suddenly. The catalyst often misses the boat, so by the time an uptrend is signaled, it may already have taken place. Second, such techniques must ultimately be self-defeating. As more and more people use it, the value of any techniques depreciates. No buy or sell signal can be worthwhile if everyone tries to act on it simultaneously. Moreover, traders tend to anticipate technical signals. If they see a price about to break through a resistance area, they tend to buy before, not after, it breaks through. If it ever was portfolio to use such chattering techniques, it will now be possible only for those who anticipate the signals. This suggests that others will try to anticipate the signal still earlier. Of course, the earlier they anticipate, the less certain the day or that the signal will occur, and is the scrambling to anticipate the signal, it is the doubtful that any profitable technical trading rules can be developed. Perhaps the most telling argument against the technical method comes from the logical implications of profit maximizing behavior on the part of the investors. Suppose, for example, that Universal Polymers is selling at around 20 when the research chemist discovers a new production technique that promises to double the company's earnings and the stock price. Now Sam is convinced that the price of the Universal will hit 40 when the news of his discovery comes out, because any purchases below the 40 will provide us swift profit. So he may well buy up all the stock can until the price hit 40, a process that could take no longer than a few minutes. Even if Sam doesn't have enough money to drive up the price himself, surely his friends and the financial institutions do have the funds to move the prices so rapidly that no catalyst could get into the act before the whole plate is gone. The point is that the market may well be the most efficient mechanism. If some people know that the price will go to 40 tomorrow, so it will go to the 40 today. Of course, if Sam makes a public announcement of the discovery, as the law requires, the argument holds with even greater force. Prices may adjust so quickly to new information as to make the whole process of technical analysis a fertile exercise. In the next chapter, I will examine whether the evidence supports such a pessimistic view of the chattering. So this is the opposite side. So how can we might the chattering fail to work or some success? So and so we need to go the next paragraph. From chartlist to technician, although the chartlists are not held in high repute on Wall Street, their colorful methods suggesting an easy way to get rich quick have attracted a wide following. The companies that manufacture and distribute stock charters, and the computer programmers who provide charting software for individuals, securities firms, and financial news networks such as CNBC and Bloomberg have enjoyed a boom in their sales, and chartists themselves still found excellent employment opportunities with the mutual funds and the brokerage firms. In the days before the computer, the laborious task of the charting course through the market was done by hand. The chartists were often viewed as peculiar people with green eyes and carbon on their fingers, who were away tucked away in a small closet back of the office. Now chartists have the services of the marvelous personal computer, hooked into a variety of the data networks and equipped with a large displayed terminal which, at the tap of a finger, can produce any conceivable chart one might want to see. The chartist, now always called it a technician, can, with the glee of a little child playing with a new electronic train, produce a complete chart of a stock's past performance, including the measures of the volume, the 200-day moving average, an average of prices over the previous 200 days recalculated each day, the strength of the stock, the relative to the market and relative to its industry, and literally the hundreds of other averages, ratios, oscillometers, and indicators. Moreover, individuals can gain easy access to a variety of charts for different time periods through internet sites such as Yahoo,